WeWork has received a warm welcome on Wall Street 2 years after its failed initial public offering. The company is far smaller than it was in 2019, when it was the largest tenant in New York City. But investors are betting that under new management, it can finally start making some money. Well, for more on this, we're joined from New York by tech analyst Daniel Ives, who's also the managing director at Wedbush Securities. Good to have you back with us, Daniel. Firstly, after more than 2 years, WeWork has finally gone public through a Spac this time. We know that in 2019, it had planned to list on Wall Street with a valuation of more than $45 billion. It's now valued at around $9 billion. How did this debut go on Wall Street? Do you think it was a success?
Look, I think it's a small victory, especially given the last few years. But this is a company that it's totally different than it was a few years ago. Newman obviously out. They've cut significant costs, about $1 billion of cost out. Now occupancy is starting to move up. Look, I think it's a positive. It's clearly a step in the right direction for what's really been a horror movie, over the last few years that started to get course corrected.
Let's reflect on WeWork's woes for a minute, because for a year or so, I mean, it was considered the biggest startup on Wall Street. As I said, it was valued at over $45 billion, $47 billion. In fact, it attracted the likes of SoftBank in terms of its major investor. Explain to us what went wrong. How did everything sort of fall from grace for WeWork?
I mean, we could spend hours talking about what went wrong and why. I think there's actually documentaries on that. Look, at the end of the day, this was a black eye for SoftBank. It's a company that ultimately grew at a pace that was not sustainable and was losing just massive monies, from every component. And it was a business model at that scale that was never going to work. You talk about valuation 45, 50 billion to where it is today. Now obviously significantly scaled down. But I think it's a case study for sometimes something that maybe seems like a good idea is not a good investment. And that's really what happened with WeWork. And Newman was, clearly a big part of that. And obviously him being out of the WeWork story is ultimately the reason that this company now is public.
Let's look at the fundamentals of WeWork, because it's essentially an office sharing company, but it doesn't actually own the property that it rents out to those looking for a desk or a room. And I'm wondering, it is interesting that the company has chosen to list during a pandemic. Yes, it seems like the worst is over, but a lot of people are still working from home. A lot of people are still reluctant to work from offices. Do you believe that WeWork's future is a solid one, given the current situation that we're in?
No, I mean, they clearly have massive headwinds on the horizon. I mean, I think this is one, obviously, them listing is, I think a step in the right direction for them strategically, but, occupancy is still 60%. You talk about the overall business model, it's still something where I think many investors are skeptical about its growth prospects over the coming years. So I view this as a small victory today, but it's still, I'll call an Everest-like climb to get to any sort of business model that could be sustainable over the long term that many investors will start to invest in.
And we know that one of the reasons why WeWork was exposed for its failings was because it had chosen to list on Wall Street in the traditional method. It meant that it had to open up its books, and then people started scrutinizing the numbers, which simply didn't add up. A lot of those checks and balances don't really apply when a company lists through a SPAC. Do you think that perhaps they chose to do this because they were perhaps unsure about the further scrutiny to their books?
Look, ultimately, even now in a SPAC, I mean, it's really going to have to come out in the numbers. So as they prove it out, public investors will decide one way or another, if this what the business model is valued at and what numbers look like going forward. But when you go back to the potential IPO a few years ago and that whole sort of soap opera, I think I think it changed the public markets in terms of companies that could come through or much more scrutiny. And I think it's a cautionary red flag for some companies that really changed the dynamics of what we see even today. So I could say there was a learning lesson that ultimately, now has proven to be maybe a benefit for other companies that would have gone down that route.
Okay, Daniel Ives from Wedbush Securities, thank you as
Thank
always
you.
for your analysis.